The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday and we're going to be talking about money. Now here's a question for you. There's a fighter pilot who has flown 150 missions. Each mission has averaged 3 hours. The longest mission was 7 hours. The shortest mission was 2 hours. The pilot has flown those missions in 5 different aircraft, 5 different fighter jets. So the question is this: how old is the pilot? And is the pilot a man or a woman? I want to thank the people who have founded Math is Love for providing the thought that brought this question to the surface. Think about that. What is the age of the pilot? And is the pilot a male or a female? We're going to answer that question later in the program, so I give you time to think about it. So I had a meeting the other day, and it was a meeting for a program committee, and they were talking about speakers, and one of the people suggested bringing in somebody to talk about a balanced federal budget. And there's a growing trend. You can read about it. It's a growing idea. And it's one of those times in which it's already gotten approval in 28 states. They're pushing for a states convention, a convention of bringing together 34 states can ask for a constitutional convention. Constitutional convention has to be called. If you have 38 states, you can approve an amendment to the United States Constitution that would require a balanced budget should all 38 states vote for that, or should there be a two-thirds majority, which would be 38 states. They can pass a constitutional amendment. The other way you can institute a constitutional amendment, of course, is for Congress to pass a bill out that would have to be approved by 38 states, at least 38 states. That bill has been put into the House of Representatives, but it never made it out of the Senate. We're going to talk about the impact of that, because I think the impact of that would be a disaster. But I'll explain that. To understand that, it's not the first time in our history that those thoughts have come up. It's not the first time we've been without the current financial system. So everybody talks about the Great Recession of 2008, 2009, and then before that there was the Great Depression, and everybody kind of forgets that before the Great Depression, before the Great Recession, we went through a number of panics. 1792, there was a panic due to the debt from the Revolutionary War. In 1890, the country was beginning to expand and grow, and there was a lot of credit. There were a number of banks that were established. They were loaning money out. And in 1819, there was a panic, a bank panic, a financial crisis, and that was a very difficult time, just like 2008, 2009. That was followed by a panic in 1837. But before we get to 1837, there was something that happened in between, which I think is instructive. People looking back in 1825, we're looking back at the time in 1819, the panic. In 1791, with Alexander Hamilton being the Treasury Secretary, they established the Bank of the United States. It was a central bank, just like the Federal Reserve. It was a central bank, just like the central bank in France, the central bank in the UK, Germany, in the Eurozone. The idea was they needed something for handling U.S. government finances for the mint and all those things. Hamilton pushed that, but it had a 20-year limit. So that bank went out of existence in 1811. Now, during that period of time, there was a lot of expansion in the economy. The economy was growing. People were moving west as far as what was then considered the West, which we consider the East. But people were moving. There was expansion. But that charter bank, the U.S. Bank, went out of existence. Looking back in 1919 with that panic, people began to see the need for a central bank. Now, in 1825 was a presidential election, or actually the election was in 1824, and there were 4 candidates. Unlike today's system with only 2 parties, there were actually 4 parties that were significant parties. We have 2 parties and then a couple additional people, but in that time, there were 4 parties. And when the House of Representatives came together, when the election came ready to be implemented, the 4 candidates were Andrew Jackson, who had won the popular vote and had 99 committed electoral college votes. John Quincy Adams had 84, not the top vote getter. Henry Clay had 37, and William Crawford, the former Treasury Secretary, had 41. And Crawford was actually the legitimate compromise candidate. If everything would have come together, there was not a majority candidate. Crawford looked like he was going to be the president of the United States. It looked like there was going to be a compromise, and he looked like the compromise candidate who was going to succeed to the presidency. But before the vote took place, Crawford had a stroke, and suddenly they were left without a compromise candidate. Henry Clay threw his support to John Quincy Adams and encouraged the Crawford Electoral College voters, those elected to the House of Representatives. He recommended they vote for John Quincy Adams, and they did. John Quincy Adams became president. Even though Andrew Jackson had won the most popular votes, he was denied. And Jackson and his supporters never forgave John Quincy Adams. They never forgot what happened. And every bill that was introduced into Congress, they killed. It was a time of just say no. So what we've watched in this gridlock in Congress in the last 8 years, we experienced at that time, 1825 through the 1830s, we had a Congress which vetoed everything with the exception of a few bills. One was called a tariff bill, which later became known as the Bill of Abominations. The idea was to protect the northern states from lower imports from Britain, to force the southern states to buy from the north or pay higher prices, and it became a significant factor that led to the Civil War. It wasn't just slavery, it was this economic impact of the Bill of Abominations. That was one of Jackson's real pushes, was to get that through. Also in that Congress, there had been proposed the Second National Bank, a bank with a 20-year charter to be a central bank. But the Jackson group killed that. Without that bank, however, you come through the panic of 1819, things were beginning to roll around. It was a period of time just like we're seeing today where we're seeing the stock market go, we're seeing the economy grow. If you look around Seattle, you see 60 cranes. Well, they didn't have cranes in those days, but they were building. It was a time of expansion. It was a time of a lot of credit. It was a time that money was being lent and production was building. There were crafts being done. There was manufacturing to the extent that we did manufacturing in those days. And it continued. And the base strongest part of the economy was the growth of cotton. Cotton was being exported to England, where it was being made into cloth, and that was a major export. In 1837, demand for cotton dropped off a cliff, and things came crashing down. Not only that, Jackson had been elected president in 1836, became inaugurated in 1837, and he forced through a bill to tie the dollar to gold. Everything came crashing down. The debt from the War of 1812 were 70% of GDP, and Jackson wanted to pay that off. He sold the lands in the West, he raised tariffs, and the central bank was never able to respond to the crisis of 1837. It was the first Great Depression in the country. While we didn't have a central bank, Congress looked to England and to France, and both the central banks in England and France came to the aid of the U.S. and bailed us out. We went on to have another panic in 1848, but the economy actually began to recover. That would change later in that century. We'll be back. Don't go away. You want to hear what happens the rest of the century.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about the financial crises that happened and the conflicts that happened trying to establish the Second National Bank, a central bank. That was a difficult fight as we went through the financial crises of 1819, 1837, and 1848. But the Second National Bank finally got passed. It was a 20-year charter. That too would expire. That would expire in the 1860s. So here we have no central bank, and in 1874 we had a financial crisis again. 1874 was unlike any other there would ever be. In 1837, the First Great Depression, the Bank of England and the Bank of France had bailed us out. In 1848, the Bank of England and the Bank of France had also stepped up. So both of those times had come with support. We had the Second National Bank by 1848, and so we had a central bank to also step in. A central bank, the main purpose of a central bank is to be the lender of last resort. When the banks are in trouble, they become the lender of last resort. But by 1874, the Second National Bank didn't exist anymore. There was no central bank. And when the panic hit, Congress debated what to do. And they decided they didn't want to do anything. The arguments are the same in 1874 that you heard in 2008 for the people who were against the TARP, for the people who were against the Federal Reserve pumping out money and doing QE1, QE2, QE3. The same arguments were used then. The businesses that should survive are those that were healthy. Let the poor businesses fail. The people that lost their jobs, let them search for a new job. Those were the things that were said in 1874 and 75 and 76 and 77 and 85 and 88. From 1874, for a period of over 30 years, we went through times like 2008, 2009. They didn't keep track of how many people were unemployed, but the estimates are it was in excess of 20% of the people were unemployed. 20%. Think about it. 2008, 2009, we saw 10%. The Great Depression, we saw 20%. But 1874, it was not a short period of time, and nobody wanted to put those people to work. They scrounged for themselves. And it was a time in which a number of farms went out of business, were foreclosed on, and for a period of almost 30 years, it was a deflationary period. Prices continued to go down and down and down. Businesses continued to fail and fail and fail. It was a very, very difficult time when you think about it. And all during that time, the economy was actually undergoing a shift because those people, most of the people who were unemployed came off the farms and the farms were failing. They moved to the cities. They started crafts. They started small businesses. In that respect, it became really the industrialization of the United States. That was a positive effect, but it was a very, very difficult time. Imagine what 2008 would be like if it extended to 2038. The Federal Reserve would finally be established in 1913. 1913, finally, they realized the need for a central bank to do something about it. So that brings me back to the original question. The meeting the other day, one person brought up the fact that and proposed that we should talk about a balanced budget. A constitutional amendment to require the federal government to have a balanced budget, just like we require the state of Washington to have a balanced budget. It only takes 38 states, and already 28 states have already passed bills to say they want a federal balanced budget. It takes 38 states to ratify that. In a lot of ways, it seems logical and it seems reasonable. We've got a debt that's now grown to $19 trillion. It was at one time $11 trillion not that many years ago, 2007. Now it's grown to $19 trillion. It's grown so much, it leaves a huge amount of money for every man, woman, and child to pay off. And that's the terms in which people talk about it, is the per capita amount of debt and the growth of the debt. The issue is comparing it to a person. A person has a finite life. At the end of your life, your debts are going to be paid. But if you look, compare it not to a personal debt, but think about General Electric. They've had debt for over a century. They're not worried about paying off their debt. Ford, General Motors, Boeing. Look at the companies that have debt, that continue to have debt. They're not in a situation where they say we're going to balance our budget and pay off the debt. They're in a situation where as their revenues grow, so has their debt grown. Maybe the debt hasn't grown as fast as revenues. If it grows faster than revenues, companies have real problems. But it's a time in which they're able to borrow more money because the growth is there. So if you look at countries and their debt levels, they compare the debt levels to GDP. So what happens if you have a federal debt, if you have a budget that has to be balanced at a federal level? What happens is, if you hit a recession, what happens during a recession? Businesses slow down, purchasing slows down, incomes begin to shrink, people get laid off, all those things, you begin to get lower tax revenues. So that means you have to cut back on government. But not only do you get lower tax revenues, you get safety net expenditures, which are growing up because you have unemployment benefits and you have food stamps, you have medical costs for those people that are out of work. For those people, they get those safety net benefits. And the deeper the recession, generally the bigger the push for those benefits. And those people are then adding to the unemployment. So it becomes a vicious circle. Think about what had happened if the government had not put in the TARP money and the money to do QE1 and QE2, QE3, and instead had been required to cut $1 trillion per year, over $1 trillion per year. How many people would have been laid off? That would have been approximately 10 million more people laid off during 2008, 2009. But 10 million people laid off would have further reduced the things that they bought, would have reduced the taxes they paid because they're unemployed, would have resulted in another reduction of the federal government's budget and another round of layoffs. And it's not just the federal government that would have been laying off, because the government purchases defense items, they purchase things from businesses. So businesses would have gone out of business, laying off their employees. Think about the impact of what that could do. You know, it sounds like a great idea. Federal balanced budget, we do it in the state. But when the state goes through a crisis, they can reduce the debt, but they can't have a very big impact on putting people to work and doing the things that a federal government can. It's a very different situation. You have to compare it to large companies, not small companies, not families, but you have to look at it in a realistic tone. We've gone through 2008, 2009. I don't want to go through that again, and I certainly don't want that to have an impact on where we are. I believe the economy is doing well. We're growing through it, and we'll continue to grow through it. And I believe things are coming along in the future which will reduce the total burden of the debt. But that's another program. We'll talk about that at another time. That's my thoughts on a balanced budget. Now you know. We've been through the process before. We've gone through it in previous panics. We've seen the impact in the 1870s of what it did. It was not a very nice time to go through. Anyway, want to shift gears? I have a guest who has a very interesting story to tell. Welcome to the program, Victor Melfi, who is the Vice President or Senior Vice President for Marketing and the Chief Strategy Officer for VoiceBox. Welcome to the program, Victor.
Thanks. Glad to be here.
So, let's start with your background.
My background, let's see, after 6 years as an assembler programmer, I actually went to business school toward the end of retreading myself away from technology. After which I worked for Booz Allen and Hamilton in New York in the strategy practice, where I gained a real interest in data analytics and database marketing. So when I left Booz Allen, I kind of learned the tools of that trade and industry, and then came out to the Northwest with an opportunity to grow a company, which I took public in 1997, after which I grew 2 other technology companies and sold them. I was then a venture capitalist, and I was also writing a book on mobile advertising, which then was a nascent market that interested me. My investment thesis was focused on what kind of technology will make mobile computing actually a viable business. And at the time, remember, we didn't have the innovation of smartphones. We were using WAP phones. That was very difficult. A good example of that was the kind of spurious ringtone market. Came out of nowhere, $14 billion market. Everybody was shocked. But when you thought about it, it was a concerning market because the ability to sell ringtones is based on people's appetite for variety. They love the variety and constantly changing the ringtone. But when you're selling ringtones, on a phone, think of a store where you can only see 6 products at once. So those 6 products are probably going to be...
We're going to come to a commercial break, so you want to hear the rest of this. 6 products only? What does that mean? We'll be back to this in a second. We'll also be talking about VoiceBox. Don't go away. Don't touch the dial. Stay with us.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I'm here with Victor Melfi. We were talking about ringtones because that was part of his background, a company that was marketing ringtones. And so let's pick that up.
Well, the point of the ringtone story was it really was illustrative of a basic problem in mobility at the time. You have a lot of SKUs that people want to purchase, but you can only show 4 or 6 at a time on a screen. So usually those are the high margin things, Beyonce or whatever. You make no money. Where you really make money is the University of Washington fight song. But it's so difficult to find it, given the interface, people can't purchase it. So we framed what I called the problem of the interface. And I was off looking at different technologies that could help solve the problem of the interface as computing became more mobile, and ran into VoiceBox. So that brought me to VoiceBox and brings the conversation to VoiceBox.
So let's talk about what VoiceBox does.
So VoiceBox, what attracted me to VoiceBox was they seem to have a technology which solved the problem of the interface. That is a natural language understanding, voice-based interface technology that not only allows people to get directly to the product or the answer they want. So in other words, you rarely wake up and say, I want to hear entertainment, subcat, music, subcat, classical, subcat, Bach. You say, play Bach. Yeah. And that's the power of language. And secondly, we were all becoming more mobile, so we didn't always have a screen. And VoiceBox had entered that market at a time when people were really frustrated with the limitations of voice as we knew it then, and still in some areas know it now. And that is what's called command and control, where because it's so difficult to know what people are saying, you have to guide them through the conversation, like you're calling customer service. Would you like to talk to customer service, shipping, blip, 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 and you'd have to keep drilling down. So voice, in particular, VoiceBox's solution to natural language seemed to me to be the keys to the future. Now, the company brought commercialized software in 2005, and it sat on a very powerful patent which managed context, which was really the secret sauce relative to making the interface a lot more natural.
So when you talk about context, what do you mean?
I think a good example of context in everyday life is we don't always have to repeat what we're talking about because we remember the conversation. So when I say, hey, what's the weather in Paris? How about Boston? That's much more natural than, what's the weather in Paris? What's the weather in Boston? You don't need to say that because we all know we're talking about the weather.
Yes.
So VoiceBox looked at that as a key aspect of what it is to communicate, and actually drilled that model into software and manages context so that people can have a conversation across a set of domains or topics in a very natural way. Now that example I gave you is really basic context, and now we all do that on every voice interface essentially that we use daily, be it Siri, Google, Apple, whatever. And so weather in Boston, how about New York? But what VoiceBox uniquely does, it allows you to manage context for a full conversation across topics. So that means I can say, play something by Cisco. What was the stock price for Cisco? I could say, what was the volume? Lower the volume. Now, in that case, there are two contexts, stock and music. And we're asking a question about volume. Now, what our software does is it just follows the conversation. So when I say, what was the volume? It says, that sounds like a question about stock versus music, and it tells me 2 billion shares. That's a very powerful aspect of what it is to be conversational. Not only do we do it across topics, but we do it across devices. That's very important because as the world is evolving, we're using multiple devices in our daily lives, and increasingly more have voice interfaces. So I want to be able to have a continuous conversation regardless to what device I'm on. So I might be on my phone and I say, play some jazz, and I walk into my house and I say to my speaker in the house, continue playing. So I can continue the experience in the conversation across device. So that was kind of the anchor of a portfolio of technology IP the company had that I thought was really, really meaningful. In fact, that portfolio was ranked recently by IEEE as among the top 15 most impactful technology IPs in the world. And you can imagine VoiceBox is one of the few smaller companies you'd find on that list. And that's because, that they found that, when you look at where the future is going, this technology, while the portfolio might be small compared to IBM's or Microsoft's, it's really quite relevant to where the world is going.
And it seems really relevant when you begin to think about the Internet of Things, because we're moving that way so that you walk into your house and say, turn up the temperature to 71. You don't have to touch the thermostat. It hears you, it turns it up.
Right, and therein lies the future of the company. The company's been a pioneer in natural language understanding and was the first to actually launch a system in a car in 2008 with Toyota that broke down that menu paradigm, command and control. The next wave of innovation the company adopted was applying that to mobile, and then its long-term vision was always to move it to the home. And clearly we're seeing that direction. And as you point out, the broader Internet of Things, which allows you basically not only to access information, but also control devices using your voice, or devices which have sensors which themselves make decisions to take actions. So the company's grown remarkably. It established a lead position in automotive NLU, and that's in fact where the market made sense originally because of the use case. We're driving, we're looking, we're keeping our eyes on the road, our hands are busy. As we've moved toward mobility, the company was able to port and find its solution with a key partnership with Samsung. So now we had Toyota as an anchor in automotive, mobility came along, and we were able to partner with Samsung. And now the Internet of Things is the next wave of growth for VoiceBox. So we were recently ranked among the fastest growing companies by Puget Sound Business Journal, and we've grown 126% to exceed $30 million last year. And we continue to grow, and that's because the market is growing. And our solution was designed with a vision in mind that's now becoming a reality. So that vision is what we're now looking to bring to market in our next wave of innovation is combining artificial intelligence with the core voice proposition. So we call that voice AI. Artificial intelligence allows people to ask more fluid questions. It's easier to understand. It understands better, but more equally importantly, it's operationally much easier and less expensive to build. I mean, right now, the way everybody does it is we're building grammars up against topics like weather. A lot of that manual authoring doesn't happen using techniques of artificial intelligence. So we're looking to bring more flexibility, simpler solutions to build to a market that has expanded, well beyond the car. But as you know, and you have a connected car, the car is just another connected device, which was always part of the vision, right?
So it's a remarkable story. a remarkable company, and I think it gives people an insight into what's happening and what will be happening. It's the investment thesis. Things are changing, and it's easy to get involved in. As you said, the ringtone market was a $14 billion market. It's easy to get caught up in what was a growing technology, which begins to fade. You're on the forefront of the things that are to come.
Right. Our growth says a lot for investors because, as you're suggesting, technology goes through phases, and every time there's a significant, step function leap in innovation, rules change, players change, and there's opportunity. So the way we look at it is, if you think about our relation to the internet, we got to know the internet through the PC. We'd sit down and we would do searches and we would click on links. And every time we did that, we would be paying the search provider like Google. Then came mobility, and we moved from the point and click model to the more of a touch application-based relationship to the internet. Now, our proposition, which was the strategy on which the company was founded, but is quickly proving to be the direction we're moving in, is that voice is the next interface for the Internet of Things. Hence the growth, and hence what's really important for investors to realize is there is real disruption in the market. If you think about the traditional players and how they make the incredible amounts of money they do, it's based on the ability to guide people through the Internet. Google does it through searches with point and click. Now, increasingly, people are asking questions using their voice, so their control of the monetization of that query through the sales of advertising. I don't know if everybody realizes, but people pay to get ranked higher on the list. That's up for grabs. That is significant disruption to the economics of the core business as it's evolved. So whenever technology moves demanding a new interface, it's time to watch companies grow. There'll be winners, losers. There'll be mid-sized companies stepping up to the plate with innovation, and that's what investors want to look at.
And there'll be large companies which die.
Yeah, they're winners and losers.
There's going to be winners and losers.
And it's really interesting to watch the train as we speak. I mean, who would have thought our friends Amazon would come into the mix?
So anyway, we're coming to a commercial break. Great story, great understanding. Now you, the investor, also has greater understanding of what's happening. Don't go away. I'm back with that question that I asked at the beginning of the program. What is the age of the pilot? And is the pilot a male or a female? Don't go away. Right back.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I am back with the question that I started at the beginning of the program. And this is the question. There's a fighter pilot who's flown 150 missions. Each mission has averaged 3 hours. The longest mission was 7 hours and the shortest was 2 hours. The pilot has flown those missions in 5 different fighter jets. So the question is this: how old is the pilot? And is the pilot a male or a female? How'd you get to the answer? How did you figure it out? What calculations did you do? Well, the answer is really this. There's not enough information. There's nothing that you can figure out what the pilot's age is or whether the pilot is a male or a female. There's none of that information that's involved. There's a whole lot of data that's given and a whole lot of information, but none of it is relevant to the age of the pilot or to the sex of the pilot. None of it is relevant. And that's kind of the field that I live in. I'm in financial services world, and there's a lot of data, and there's charts, and there's all those things that take place. But so much of it is irrelevant. So much of it does not apply. It's wonderful. They build programs. I've talked a few times about financial planning. When I started Adams Financial Concepts, I went out and I bought the very best financial planning concept software you could buy. I sent one of the employees to train. Paid a lot of money for all that stuff. We ran our first report and I realized this is irrelevant. This is irrelevant. Asset allocation, reduced risk. There's a whole lot of data. And we could produce a report that was 400 pages long. 400 pages. Put all the data into it, it would spin its wheels and whistles and whatever, and you'd produce page after page after page with charts and graphs and line graphs, bar graphs, pie charts. All those things you can forecast with that program, the probability that you're going to have enough money by the time enough money so you don't run out of money before you die. You have all that information, but it's irrelevant because it's based on wrong information. Just think about it. There was an article in 2009, and I know that's a ways back, but it talked about in 2009 a 40% stock or 60% stock, 40% bond portfolio during 2008, 2009 would have lost 20% of its value. Now, looking at the basis of financial planning and using the normal curve, that should only happen once every 111 years. Once every 111 years. How do you determine that? Because you're looking at a normal distribution, that bell-shaped curve. And that bell-shaped curve is based on a very nice curve to use because 65% of the time, the returns that it projects, the values it projects are within what's called one standard deviation. 95% within 2 standard deviations. 99% within 3 standard deviations. It's a really nice mathematical tool to use. The question is it accurate? Does it apply? Does it really give you information? It's like the fighter pilot. It's 150 missions. The longest 7 hours, the shortest 2 hours, the average is 3 hours. That's the information that's there, but is it accurate? Does it tell you anything about the age of the pilot? No, nothing. All it does is provide a lot of very nice charts and bar graphs and pie charts, and it gives you a probability which has nothing to do with reality. A lot of people learned that in 2008, 2009. Planning for their retirement, suddenly everything came apart. Or people who were in retirement saw that they had to cut back more. They had to change their lifestyle. Because it assumes wrongly that all those returns are spread evenly in the bell-shaped curve. There's some things that don't change. There's some things that are very normal in terms of business. But one of those is not a normal distribution of returns. The calculation was made using the normal distribution curve that comes out of the financial planning software, that an event like happened on October 19th, 1987 will only happen once every 4 billion years. once every 4 billion years. We don't have to worry about it again. If the financial planning software is correct, we never ever have to worry, because that's not going to happen in another 4 billion, or actually 3,999,000,000,000,000 or million years. Plus, that's absolutely ludicrous. You don't have to worry about it 2008, 2009, because that's not going to happen for another 111 years. So why should you worry about it? The fact is, you do need to worry about it because of what happens in the economy. You have to worry about inflation. You have to worry about these things, and it doesn't work. And the second thing, I've talked about it before, talk about it again, is asset allocation. The idea is, don't lose clients' money. Don't lose clients' money. Clients are bothered more by loss than by the future. So you take stocks, which have an average return of 10%, you add bonds with 5%, you add cash with 2%, you add gold maybe with 3%. You add all those together, you get a return of 5%. It's mathematics. It's not rocket science. You don't need a $10,000 software program to project that. You're going to end up with 5%. Your returns are going to go down. 5% invested at 25 years. If you have $100,000, you invest for 25 years at 5%, it's going to compound, it's going to grow to $322,000. Nice, right? If it's 10% in those 25 years, that $100,000 is going to grow to $985,000. And if it's 15%, it's going to grow to $2.8 million. So to have the same amount of money growing at 15%, the market would have to drop 90%. And there's no guarantee the 322 is not going to drop as well. I think it's the fighter pilot. It doesn't tell you anything about the age, doesn't tell you anything about whether it was a male or a female pilot. It's the same thing. It looks nice. You can generate hundreds of pages of charts and graphs. The question is it really relevant? Is it going to keep you from running out of money? I don't believe so. I believe instead it increases that probability. But there's more to come, because the idea is to improve your returns. By improving the returns, and I'm not talking about taking excessive risk. I'm not talking about significantly improving taking greater risk. I'm talking about focusing on what returns are and getting a better return so that over the long term, you can afford the ups and downs. That's what it's about. You give up a little bit on the short term to gain a whole lot on the long term. That wraps it up for today. Have a very great weekend, and I'll be back next Friday to talk about money. Have a great weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.